Hello, everybody. I'm Bill Oyster. I'm a member of the firm with SEK. Today, we're going to talk to you about the importance of effective internal controls, myself and Greg Hall. You've already met Greg a little bit in the introductory portion of the seminar, but Greg is a graduate of Shippensburg University and has 30 years with SEK, and he heads up our nonprofit niche within the audit department. I've been in public accounting for 22 years, a graduate of Bloomsburg University, and I spend approximately half of my time in nonprofit accounting and auditing. So first of all, we're going to look at some red flags of fraud and how what indicators you might see that would indicate that something amiss is happening within your organization. So on this slide, the first column talks about lifestyle and personality traits that are red flags. Obviously, the first one under this column is the most prevalent, the living beyond an employee's means. And this doesn't always mean that the employee is driving a fancy car or has a second vacation home. Oftentimes, it could be other things that are listed within this column, such as having an elderly parent or having a gambling or drug addiction that could lead to that living beyond the means. Another area is the unwilling or unable to take time off. Could be a sign of a potential red flag. Typically this happens so that during that transition of duties over that vacation time, there wouldn't be a detection of the wrongdoing that's been taking place. So the employee tends to say that they're too busy or they're the only ones that can perform those procedures, and they really try to avoid taking any time off of work. So that's a big red flag, and you see that oftentimes in some of the fraud cases that come to light. The other thing is personality issues. So being overly anxious or being stressed out over and above what would be normal for a person in that position could be a red flag. So if someone has a disproportionate amount of stress or anxiety within their role in your organization, kind of might want to dig deeper and see what the underlying issue is there, and if it could lead to other potential problems. In the second column, we see some organizational risks or red flags. You see the second item, the too much trust in the key employee, is often something that comes to light within fraud cases. And we're going to go through a number of fraud cases today, and you can see that oftentimes the fraud is going to be perpetrated with someone that the entity has the utmost level of trust in. So that doesn't negate, them from committing fraud, obviously. And then a lot of the items under the column have a direct link with internal controls. So, just keep in mind that the internal controls are there for a reason. And we're going to see some cases where those controls were circumvented or not followed, and therefore the fraud was able to be perpetrated undetected for a good period of time. So it is very important to not only have a strong internal control processes and procedures, but to enforce them as well. So with that, important components of internal control include communication and monitoring, and you want to make sure that within these areas that those systems of communication and oversight aren't breaking down within your organization. There's also some personnel related red flags, such as always being in crisis mode. That kind of goes back to a little bit of the anxious or stressed out mode, but oftentimes people will cover up a fraudulent transaction by really saying that they're too busy to handle things in a proper manner, provide adequate documentation. They just didn't get to reconciling that bank account. They're just behind, and so that's just typically builds and builds until the point where you really don't have internal controls within your organization. So you want to be careful of those types of responses from employees. This next slide, the first column here, the financial documents, the first one is key too. If you're seeing a lot of missing or inaccurate documentation, incomplete records of an organization, oftentimes that's used to cover up fraudulent transactions. So when you run into that, make sure you're asking appropriate questions and that it's not a reoccurring issue within the organization, or it could really be a misappropriation that's being covered up. And then a lot of cases and ones that we'll see today have alteration of documentation as part of the fraud cover up. So people are altering invoices or checks to their benefit as part of the fraud scheme. So you want to be careful that, if you see any manipulation of invoices or checks, something doesn't look right, the font doesn't look right, there's different things like that really point to a fraud occurring. So in that, there are what they call homemade invoices as part of fraud. And a lot of times those homemade invoices are gonna omit key information or key information is gonna look unusual. So if the address or phone number is missing from an invoice, that's unusual. Most vendors are gonna include that information routinely on their invoices. So look out for those unusual things. And then, if your invoice has a phone number that's 867-5309, that's probably a good sign that it's a fraudulent invoice. Okay, so sometimes people are just going to be creative and trying to cover it up, but other times people are going to be brass and try to throw things out there, that could be easily caught and see how much they can really get away with. So paying attention to the small details and doing some spot checks are really a good control to avoid that. And then the second column here, really, that first one is the auditor's favorite buzz phrase that we like to throw out there a lot, the lack of segregation of duties. And I always like to explain exactly what that really is, because we can throw that out there, but truly understanding how that develops or why that exists. And it's really when you have control of both the physical assets and also the accounting for those assets. So take a cash receipts process, for example. So if you're the one collecting all the deposits from the customers, but you're also the one maintaining the subledgers within the accounting system and posting those transactions, that's having the physical access over those funds as well as the accounting over them. So you have a lack of segregation of duties. Those duties should be separated. So if there are any improprieties within that section, they can be caught by one or the other people involved in that process. So it's really key to understand why those things are important and you know, try to mitigate them as much as possible. And if you're unable to have a proper segregation of duties, it's important to include additional monitoring in your control processes by a board or people outside of the organization. So, and we're going to talk a little bit about ways to help mitigate some of those fraud at the end of the presentation when Greg takes over here. So in addition to, you know, the lack of segregation, you know, other things to look out for is no oversight, there's no tone at the top, no internal controls. So again, you know, the tone at the top is very important. That, you know, if people are circumventing controls or just you know, not doing them at all, there has to be consequences to that, and someone has to be monitoring that to make sure that those consequences stick, or else you can't have an effective system of internal control. So now we're going to get into some common schemes that you want to make sure that you understand how they're perpetrated and, you know, can identify them if they're happening within your organization. So the first one is check tampering, which is just forging or altering checks. And we'll see some examples of that in the fraud cases that we go through today. Accounts payable or fictitious vendors or services, which leads into invoice manipulation as well. So making sure that, you know, the invoices that the company is paying on are true and accurate, and that the services or materials that they're for have been provided. Then we talk about expense reimbursements, which is the fictitious or personal expenses reimbursed to employees. Now, this typically is a very small component of a fraud. Sometimes it can be a little bit larger with people taking personal vacations and putting it in as business expenses. But in either case, a lot of times it's kind of wrapped up into a larger fraud that's happening. So even if you find smaller instances of abuse within expense reimbursement, it's really wise to kind of step back and see whether or not there's other areas within the organization that have potential risk and things may be happening within them, because really you don't want to, you know, overlook some small offense within one area that speaks to someone's really ethics and questions that, and then not look further into other areas that they could be diverting funds to themselves. So next one's kickbacks and bribes, and we have a great example of that, a case that we'll be going over in the presentation. And payroll, fictitious employees are reporting erroneous hours. You know, obviously if someone is always sick and always missing at, you know, during the year, taking vacations, you get to the year end and they're rolling forward the maximum amount of hours each year. You know, I actually saw that within an organization, and a fraud was uncovered specific to that, you know, and then again, there was other things that were happening on top of that. So again, some of these might be small in nature when you're looking at it, but usually when bundled, they can become very significant. So theft is the, you know, just stealing cash receipts or other property of the organization. procurement card, using a credit or debit card for personal expenses. There again, you'll have mistakes where someone will pull out the wrong card and use it. But usually once a person makes that mistake once, they're going to be very careful that it never happens again. So if you have a person that's a multiple time offender, within that area, you might want to step back and really say, is this really, an accident, or is there something else going on there? And then kiting is stealing cash receipts and covering it up with other funds received. Now that's a more complicated scheme of covering up theft of cash receipts with subsequent payments from the same or different customers. So that tends to be a little bit more involved of a scheme, and typically the person perpetrating it is a little bit more sophisticated and trying to cover up that theft. So now we're just going to get into some interesting fraud cases. These are real life examples of frauds that have been perpetrated within nonprofits, and just kind of want to take away from them how this could potentially be perpetrated within your own organization. So when we read through this, think about your own organizations and if any of these things could be happening within them, and what controls should be in place or are already in place to help prevent that. So in an egregious case of nonprofit embezzlement, a 44-year-old administrative assistant who worked at the Association of American Medical Colleges stole $5.1 million over an 8-year period. The organization, which is located in Washington, D.C., administers the Medical College Admissions Test and represents universities and colleges across the nation. She created fake company names that were close to the names of actual vendors. And you'll see that oftentimes in fraud cases, that people are very creative and just very minor tweaks of vendor names to try to make it sound like it's a legitimate vendor. So be careful of those variations. So she would then create invoices in the name of the fake companies so that the checks would be issued to them. Finally, she would deposit the money into her own personal account. She used $1.8 million to keep a bridal shop that she owned afloat. The long fraud scheme fell apart when a bank noticed that something was amiss. So this fraud was not uncovered by an audit process. It was uncovered by the bank, and it doesn't really get into too much of the specifics there, but I'm imagining this was, either caught by her personal bank as she's depositing these large checks from vendors into her personal checking account. I would imagine that's how it was detected. But as you can see, there's probably not any real bright lines of her living beyond her means. Maybe a lot of the people that she worked with didn't know that her business was failing, and that's why she's diverting these funds. But that is a red flag in that, you're always going to have instances where you have people with their own business that are involved in finances of the organization. There's an increased risk there. And I saw personally myself a case where someone was paying the payroll tax withholdings for their personal company through the organization that they work for. So it's just an increased risk when you have that kind of situation. So a 54-year-old Connecticut woman reportedly stole $800,000 from National Veterans Service Fund, a nonprofit organization that provides social services and medical help to veterans of the Vietnam and Persian Gulf Wars and their families. She worked as a bookkeeper at the organization. During a 5-year period from 2009 to 2014, she diverted $800,000 from the organization to pay for her own needs and made fraudulent entries into the organization's books to cover her tracks. The fraud was uncovered when an accounting firm found irregularities in the agency's financial statements. According to the affidavit, she fabricated a financial ledger that indicates the checks were written to veterans of the organization and clients. However, police said she made the checks out to herself and family members. She also made electronic payments for her car loans and used the agency credit cards for personal expense, such as airfare, vacations, and internet purchases, according to court documents. Police found that all the suspect ledger memos were actually the organization's clients who had received assistance from the organization during the last 7 years. However, the actual checks indicated she made them out to herself or family members. So, this is, someone that had a short term with the organization before they committed the fraud. She was hired in 2008, started committing the fraud in 2009 through 2014. So she might not have been the highly trusted individual, but again, there's some lack of controls that are happening in the organization. No one's really reviewing those clear checks or that bank reconciliation process to really identify what's truly going on here. So the former director of operations at Odyssey House, Inc., a Manhattan substance abuse treatment organization, was charged with bid rigging, conspiracy to defraud, and income tax evasion in connection with the conspiracy to embezzle approximately $2.3 million from the organization over an 8-year period. He conspired with several outside vendors to rig bids and allocate contracts awarded by Odyssey House for the supply of food, meat, health, beauty supplies, baby supplies, office supplies, printed materials, janitorial supplies, and medical supplies. So basically everything they bought, this guy was getting a kickback on. It happened from 1990 until at least April 1998. So approximately 7 to 8 years there. According to the charge, he steered nearly 10 million in contracts to those vendors, neglecting the organization's competitive bidding requirements. The second count charged him with taking kickbacks totaling at least $364,000 in cash or goods and services from vendors to ensure that he allocated them to a portion of the total of the contracts awarded. In addition, he had 7 unidentified vendors embezzled at least $2.3 million from the organization by issuing false and fraudulent purchase orders to each of the 7 vendors, who in turn issued corresponding invoices for goods and services that were never delivered or provided. As of the date of the article, 22 individuals and 9 corporations had already been convicted of various federal charges. So as you can see, this was a little bit more complicated of a fraud scheme, involved many different people outside of the organization. But again, there was really no controls in place to prevent this from happening. Even though the organization had bidding requirements, those obviously weren't being oversighted properly, that even if they did go out for bid for the materials that were purchased, this individual had the control to direct that to people that would provide kickbacks to him. So the CEO of the United Way for 22 years, together with a CFO and partnership umbrella president, were indicted on 53 counts of fraud and were accused of embezzling more than 1.2 million from the United Way. The frauds range from altered expense reports to lavish trips to siphoning funds through a spin-off organization, the United Way Partnership Umbrella. His expenses were required to be approved by members of the board of directors, but this appears to have occurred rarely, if ever. Again, this was something that they circumvented the internal controls that were in place at the organization. Members of the board also appeared to have disregarded warning signs of irregularities when they received them. The then chairman of the board for the United Way received an anonymous letter in 1990 warning that the United Way was being looted from the inside. According to his testimony, he asked around to see if anyone had heard anything. Hearing nothing, he dropped the matter. So right there, the proper tone at the top wasn't being emitted throughout the organization. Obviously, if someone brought forth those types of accusations, they should have been reported to the auditor, to investigate as part of their processes. It doesn't say that that didn't happen within the article, but it's obvious from what was quoted there that it probably didn't. So catching this fraud wouldn't have required a deep knowledge of accounting, merely the will to look closely at how large sums of money were being spent and whether they seemed reasonable. In this case, if the United Way and even basic internal controls, or if the board of directors had performed its oversight duties, the fraud might not have ever taken place, or at least might have been caught early. The last case that we'll take a look at here is perpetrated by the founder. So the founder of an Erie nonprofit organization and Erie County president has been indicted by a federal grand jury in Erie on charges of wire fraud and theft of government property, falsifying documents to the government. According to the indictment presented to the court, she diverted funds donated to Mothers Against Teen Violence, a nonprofit organization she created to help prevent violence amongst teenagers, to pay for her gambling and personal expenses. Specifically, in the indictment alleges that from December 2011 to March 2018, she engaged in a scheme to defraud the organization of at least $70,000. She allegedly solicited donations from individuals and entities in person and by email, receiving donations in cash and checks payable to the organization and depositing some of that into the organization's account and some into her own personal account. She also spent organization funds for things like personal items of clothing, groceries, car washes, and food at restaurants, and to pay personal bills. The indictment alleges that on 113 occasions from April 2012 to January 2018, she used the organization debit card to withdraw funds at a casino. The indictment also alleges that she fraudulently received approximately $30,000 in Social Security disability benefits and submitted a document to the Social Security Administration that contained false statements. So, in all these cases, the key, in giving you some variety of stories here, you can see there's different levels that fraud can be perpetrated at. It's from the top bottom. We saw cases where the founder, CFO, president, CEO were involved. And we saw cases where a bookkeeper or administrative assistant were involved. So fraud can take place at all levels. You really need to look out, and be attentive of these risk areas and make sure that your internal controls are being properly handled. So from that, I'm going to now hand it over to Greg Hall, who's going to go over some ways to deter fraud.
All right, I want to thank everybody for listening to Bill there, and I'll take over from here on the controls for fraud. When I look at organizations, I see three types of organizations currently out there. I see those organizations who've already experienced fraud and it's in their past. And that would include organizations whom they didn't even know the fraud was occurring. They may have had suspicions and maybe not even suspicions, but it has occurred. The other thing I see is organizations where you currently have fraud occurring. And they might not know it's occurring, but it's happening, or they might have just discovered it. And the third type of organization out there is those that have not yet experienced fraud, but unfortunately those items, it probably will happen sooner or later to those organizations. The important thing is to make sure you at least take the steps to try and mitigate that. And if it does occur, catch it as soon as it does. Some of the things Bill has talked about here and has already mentioned, lack of segregation of duties. It's important in organizations that you look at the steps and process that you have for handling the asset. The idea is that the person who has control of the asset is not the same person who's actually recording the transaction. So the work of one individual is always under another individual. That's very important. And I would recommend all organizations, no matter what your size, once a year, take a look at what your processes are, particularly look at where you switch duties during the year. I've had entities switch duties and make changes. And when you ask them the questions, well, what are the controls in place now that you combine these? And you have a surprised look on my client's face, that's one thing they didn't consider. And so at that point, they're usually going back and scrambling to make changes to the process of that. I would say this, large organizations, a lot of the large healthcare organizations I deal with that has several levels of management in place, they have, if not having all of these, they probably have 90% of these controls in place. Small organizations that I deal with may have one or two of these in place, and just don't have the staff resources and budgets to afford to do what a larger organization would do in that respect. Some of the more common ones that all organizations should be doing is, one, having someone review the bank reconciliations and having someone review those reconciliations. Particularly in the small organizations, the fraud that we typically run into has to do with taking money out of the cash account. Somebody has the ability to write checks. They realize no one's watching them. Next thing, they're writing checks out to themselves. They're giving themselves extra payroll and no one's monitoring that. A lot of cases, just reviewing the bank reconciliations to make sure they're done timely, and then checking in the bank balance with the bank balance on the reconciliation, looking for items that have been outstanding for a large period of time, making sure it ties to the general ledger. Larger organizations typically have those built in, and that occurs. Large organizations, if we're seeing fraud, it has to do more with some type of taking some type of asset, not necessarily cash, or it could be some type of misstating financial results to meet bond covenants or something. So those types of fraud tend to be more higher level accounting, not so much lower level. Small organizations, it's basically just the not reconciling bank accounts, taking cash out of the account, and so forth. Obviously, one key thing here is the tone at the top. All organizations should have a tone at the top that lets people know that they're serious about control. Some of that would be, if fraud is detected, that person is prosecuted or some action is taken, that people at the organization know that they're serious. Otherwise, that will happen again, because employees are watching what management does as well. Other things for small nonprofits that are good is having dual signatures on a check, more than one check signer, and never ever sign a check without getting the invoices attached. So when somebody's signing checks, one of the controls I always ask is, do you get the supporting documents and are able to go through and look at what you're signing and approving it, make sure it exists there. The other things to keep in mind for small organizations is budgeting. Budgeting is not only a profit plan, perhaps for the current year or upcoming years. A budget is actually a form of control. And with that, you should be getting a financial statement, a balance sheet, income statement comparing budget to actual as well. And if things are really getting out of whack regarding the budgets, management and the board should be asking questions regarding what's going on. That is their duty, their fiduciary duty, to ask those questions and hold management accountable for not meeting those budget areas. So that is a control which a lot of people, I think, take for granted but don't realize that is a form of control. Very high level control, but it is a form of control that occurs there as well. Also, a lot of small organizations tend to overlook bonding for their key employees. Most commercial policies have some amount in there. The issue is to discuss that with your agent and make sure that appears appropriate for your needs. I'm not someone to recommend anything. The only thing I will say is for housing and Department of Housing and Urban Development, for their management agents, requires them to carry 2 months of cash flow as the bond, as a minimum. So if you collect $100,000 a month, HUD would say you need to have a $200,000 bond. That's their guidelines, but I would really highly recommend you talk about that with your insurance agent as well. Also, board oversight for small organizations is really key. Boards should, in my opinion, should actually have 3 people on it, in addition to people who understand the programs. You should really have a accountant, could be somebody involved in financial processes like a banker, an accountant, but can look at the statements and understand what they're looking at to make up perhaps on a small organization board don't have that expertise. You should probably also have either an HR and or a attorney on the board, because a lot of cases HR and legal tend to blend together. I've seen issue comes up, it's usually an HR issue. HR issue can handle it, but a lot of cases attorneys are familiar with those things too. And the third person is an insurance agent to make sure that you've got the proper insurance in place and can help monitor the annual insurance renewal process. Always pay attention for instances of fraud where employees bring you information, and just don't let the CFO or somebody handle it. If it's involving the CFO, CEO needs to take it responsibly and check that out themselves. Some things that could come from detection fraud. I had one, my first one I was involved with a quarter century ago, was a mailman actually discovered the fraud. His actions led to discovery. It was a small professional practice. The office manager had met the mailman on her day off, halfway through his route, and asked for the mail. The mailman said, "I can't give this to you because of postal regulations." She then met him again on the porch of the office and said, "I'm here now. Can you give me the mail?" He goes, "Well, I can't give it to you. I got to put it into the slot according to postal regulations. I got to put it in the appropriate receptacle." Well, the receptacle there went right into the office, and he left, and she never went in. He thought that was strange, so he told the postmaster. The postmaster called this professional services company. They checked the mail and found out that their electric was all but going to be shut off soon, that there was IRS notices they found in there, and essentially he was working all these very long hours and couldn't understand why he wasn't making money, but that did help him understand how his administrative assistant could buy 2 rental properties, put a pool in, and buy a hunting cabin in another county. So that basically straightened out. So always be aware of instances where people are bringing you indications there could be fraud, because it could be occurring. And just remember what I said, either your business has been a victim of fraud, it's currently happening, or someplace down the road, somebody's going to see a weakness, take advantage of an opportunity to do that. So